What we could expect if there is a next housing crash. If you want to prosper in these times and understand why this is happening, stay until the end of this video. We'll explain key data regarding the market and you'll learn what to look for when analyzing the real estate sector. Hello and welcome to the Market Watcher, a place for gathering crypto and traditional financial knowledge on a regular basis. Make sure you subscribe to our channel and hit the bell icon so that you won't miss out any of our invaluable content. As always, everything said in this video is with educational purposes and should not be considered as financial advice. The information is derived from official data coming from the Federal Reserve of America and also from one of the great financial analysts, Charlie Belillo, and some data is coming from Incrementum. Let's start with the first chart, which shows the growth of the housing market in the United States. On the chart, we can see the median price of an existing US home. The current level sits at the astonishing $407,000, and since the start of the pandemic, the median home price has skyrocketed by 44%. Which is an insane amount, and it is all due to the enormous money printing which was implemented by the Fed since the middle of 2020. On average, US homes have appreciated in price on par with inflation, or in other words, the normal average yearly appreciation of a home should be between 3 to 4%, which is the historical average US inflation. According to data stemming from worlddata.info, the average US inflation from the period of the 1960s to 2021 was 3.8%, and the current divergence between the inflation and the US home price appreciation is quite historic, and we will see that in a moment. The highest property increases are seen in the cities of Tampa with a 35.8% increase in the past year, Miami with a 33.3% increase, and on third place is Phoenix with a 31.3% increase. It is important for us to take a look at the rental situation. According to data derived from Apartment List from June of 2021 until June of 2022, the average monthly rent has increased with a massive 14.1%, which is a record amount seen from a historical perspective. As stated by Apartment List, the biggest cities all have experienced rent increases, with 97 out of the top 100 cities seeing a rise in rents. On the next chart, you can see the fastest growing metro areas by rent growth. The increases are enormous. Since March of 2020, the fastest growing rents are seen in Tampa with a 42% increase, and then Rochester and Tucson with a respected 41 and a 40% increase. While over the last 6 months, first are San Jose, again Rochester and New York, all with or above a 10% rent increase in just half a year. The next chart, which we'll cover, shows the insane divergence between the inflation level and the current home price appreciation. Over the last 131 years, we have never seen such a disproportionate level of 135%. This means that the year-on-year housing appreciation is 2.3 times the actual inflation level. For example, if today's year-over-year inflation is 10% and the average median home price has increased by 20%, this means we are at 100% divergence. In today's case, the inflation sits at a 8.6% level, while the year-on-year change of homes is at a 20.2%. The biggest divergence on the downside was seen in 1918, when the US year-over-year inflation was 17.97%, and the median home price appreciated by only 11.32%. Now we must take a look at the major reasons why we are about to experience a massive US home price crash in the coming months or 1 to 2 years. This reason is the massive spike in the US 30-year fixed mortgage rates. This is one of the fastest spikes on record, and it directly increases the monthly payments for newly issued mortgages. This makes it much less affordable for new home buyers to buy a home, which in turn drives the demand down, and the prices at a certain point will inevitably fall. As expressed by Brenda Richardson from Forbes, the average home buyer's monthly payment shot up by 39%, which is the biggest annual gain on record. The bad news for both current home buyers and the economy is that in the coming months the Fed will continue to increase its main interest rate, called the Federal Reserve's fund rate. This pushes the cost for all debts higher, and this means that the mortgage payments will only keep increasing in the coming months. The predicted increases are 0.75% in July, then a 0.5% increase in September and November, and to end the year, the plan is to have a 0.25% increase. As always, those are current plans of the Fed, but they could change in a heartbeat. It all depends on what happens to the economy in the short term. The reason why the Fed is doing this is because they want to drastically lower the inflation rate, and the rising of the main interest rate is their main tool by which they can implement those goals. For sure, watch our previous videos about the macroeconomy, where we explain the current macro environment and the nasty situation in which all developed economies are trapped in. For now, the increases in the mortgage rates are disproportionately affecting the lower income population of the US, as seen by this next chart. The sales of homes with lower prices are drastically dropping compared to higher cost homes. This says to us that there is an increase in inequality, and for now, higher priced homes are still being purchased by wealthier Americans who use those homes as a way to escape from the inflation. Currently, the wealth inequality in the United States is one of the highest in history, which means the wealthy have never been so rich, while the poor have never been poorer. The next chart shows the ratio between the average home price versus per capita disposable income. Currently, the ratio is the highest in the last 40 years, and it sits at a 10.31, which means that home prices have never been so expensive compared to normal disposable income. Disposable income is income remaining after the deduction of taxes and social security charges, available to be spent or saved as one wishes. During the early stages of the pandemic, the levels were low due to the fact that home prices were 44% lower, and at the same time due to the stimulus checks which were being distributed and the lack of options to spend due to the closing of all kinds of venues, the ratio was quite low. On the next chart, we see the US High Index, which is translated as Housing Affordability Index, to qualify for a mortgage loan on a typical home at the national and regional levels based on the most recent price and income data. Currently, the affordability index is at its lowest level since the pre-housing crash levels of 2007. The mind-blowing part here is that still the unaffordability is probably going to increase, meaning this index will continue to drop due to the fact that from here the Fed plans to start increasing its main interest rate, which, as we said, will increase the monthly mortgage rates and thus make it less affordable for new home buyers to enter the market. Already, the sales of existing homes are starting to fall, as seen on the next chart. The current year-over-year change is 9% to the downside, and the levels are sitting at the levels of June of 2020. The less sales of existing homes, the less likely it is we'll see a new all-time high for the real estate market, at least in the coming years. Another fact which supports the thesis of the upcoming housing crash is still the high level of new housing starts, which is the last chart we'll examine. Currently, the change on a year-over-year basis is minus 3%, but still new homes are continuing to enter the market, which brings the supply up while the demand is starting to slow down. The bad news for home builders is that when they started their projects, the interest rates were much lower and there was no sign of future rate hikes. When a new housing project is started, it usually takes between 12 to 24 months for it to be finished, which means that still a lot of new supply will enter the market, and only after the crisis has started will new homes stop being built. We covered a tremendous amount of important information, and now you know which are the main and key drivers and factors which we need to look out for when examining the state of the real estate market. Subscribe to the channel, share the video, and express your thoughts in the comments section below. And of course, don't forget to continue your education with our content. Thank you for watching until the end, and I'll see you in the next video.